Picture this. Your grandfather worked at a factory for 30 years. No college degree. Just showed up, did the work, and went home. By the time he retired, he owned a house. He had a pension. He sent his kids to college. He took one vacation a year. He was not rich. He was not famous. He was middle class. And that was enough. Now fast forward to today. You have a degree, maybe two. You work 2 jobs. You're renting an apartment. You have $400 in savings. And you're one emergency away from total disaster. What happened? This isn't a story about laziness. It's not about avocado toast or bad spending habits. This is the story of how the middle class, the backbone of the most powerful economy on earth, quietly, slowly, almost invisibly, got hollowed out. And almost nobody noticed until it was too late. To understand what was lost, you have to understand what was built. Let's go back, way back. It's 1945. World War II just ended. America is in a strange position. Every other major economy on Earth is in ruins. Europe is rubble. Japan is ash. China is in civil war. But America? America's factories are intact. America's workers are home. And America has something no one else has. Money, momentum, and muscle. The next 30 years, roughly 1945 to 1975 economists would later call them the Great Compression. Not because things were squeezed, but because the gap between rich and poor actually shrank. Think about that. A rising tide that actually lifted every boat. Here's how it worked. Unions were powerful, seriously powerful. In 1955, 1 in 3 American workers belonged to a union. That meant when the company made money, workers got a piece. Higher wages, better benefits, pensions, health insurance, the whole package. The government was also building things. Roads, schools, the entire interstate highway system. The GI Bill sent millions of veterans to college for free. And corporations? They were playing a different game back then. The CEO of a big company in 1965 made about 20 times what his average worker made. 20 times. Write that number down. We'll come back to it. But here's the key thing. Productivity and wages were basically married. When workers produced more, they got paid more. Simple, clean, fair. A factory worker could buy a house, raise 3 kids, and retire with dignity. Not because he was special, because the system was designed to let him. And that design was not an accident. But cracks don't announce themselves. They start small, invisible, and by the time you see them, the wall is already falling. It's the 1970s. America hits a wall. The oil embargo of 1973 sends gas prices through the roof. Inflation explodes. The economy starts doing something it's never done before, growing slowly and inflating fast at the same time. Economists called it stagflation, which sounds like a disease, because it basically was. And in that chaos, a new idea started spreading. The idea was simple. Government is the problem. Regulations are choking business. Taxes are too high. Let the market decide everything. It was called supply-side economics, or trickle-down economics. The pitch went like this. Give more money to companies and rich people. They'll invest it. They'll create jobs. The wealth will trickle down to everyone else. It sounded logical. It was very easy to explain. It was very hard to argue against in a political speech. And in 1980, it became official policy. Ronald Reagan swept into office. Tax cuts for the wealthy, deregulation of industries, a direct confrontation with unions. In 1981, air traffic controllers went on strike. Reagan fired all 11,000 of them. Not negotiated, not compromised. Fired. The message was received loud and clear across every industry in America. Unions were no longer untouchable. Workers had less power than they thought. And that was the beginning of the end. Now here's where it gets interesting and uncomfortable. Because what happened next didn't happen overnight. It happened slowly, over decades, in ways that were easy to miss if you weren't paying close attention. Let's talk about wages. Remember how productivity and wages used to walk hand in hand? Starting around 1979, they split up. Productivity kept going up. Workers kept producing more output, more efficiency, more value. But wages basically flatlined. Adjusted for inflation, the median American worker's wage in 2023 was barely higher than it was in 1979. 44 years, roughly the same paycheck. But everything else went up. Housing, up 400%. College tuition, up 1,200%. Healthcare, up 600%. You were running on a treadmill, working harder, getting nowhere. Now let's talk about what happened to the companies. Because while wages were flatlining, something else was exploding. Corporate profits, executive pay, shareholder returns. Remember that CEO who made 20 times his average worker's salary in 1965? By 2022, that same CEO was making 350 times. 350 times. Same company, same workers doing the work, completely different math. And this wasn't just greed, though there was plenty of that. It was a structural shift in who corporations thought they worked for. In the 1950s and 60s, companies believed they had responsibilities to workers, communities, customers, and shareholders, all of them together. Then, in 1970, an economist named Milton Friedman published a famous essay. The idea, a company's only responsibility is to maximize profit for shareholders. That idea took root, spread through business schools, MBA programs, boardrooms, Wall Street. And over time, it became the operating system of the American economy. Cut costs, boost quarterly earnings, return cash to shareholders. Workers became a cost to be minimized, not an asset to be invested in. And then came the final blow. Globalization and automation arrived at the same time. In the 1990s and 2000s, trade deals opened up the global economy. Companies could now make things cheaper somewhere else. China, Mexico, Vietnam, Bangladesh. Millions of manufacturing jobs left. Not slowly, fast. Between 2000 and 2010, America lost 5.6 million manufacturing jobs. These weren't just jobs. They were the foundation of middle-class life in hundreds of towns and cities across America. When the factory closed, everything closed. The diner closed, the hardware store closed, the Little League sponsor disappeared, the tax base collapsed, the school funding dried up. Entire communities didn't just lose jobs, they lost their reason to exist. And the people who lost those jobs were told, retrain, go back to school, learn to code. As if that were simple. As if a 2-year-old welder could just pivot to software engineering. As if the answer to a structural problem was a personal solution. But here's the cruel twist. Even as wages flattened, expectations didn't. People still wanted the life their parents had. The house, the car, the vacations, the kids in college. They just couldn't afford it on wages alone. So they borrowed. Credit cards, home equity loans, car loans, student loans. Between 1980 and 2008, household debt in America tripled as a share of income. Consumer spending kept the economy growing, but it was built on a foundation of borrowed time. And then 2008 happened. The housing market collapsed. Banks froze. The economy went into free fall. And who got bailed out? The banks. The same institutions that had handed out bad loans bundled them into toxic products and sold them to unsuspecting investors. They got $700 billion. The middle class got foreclosure notices. 8 million people lost their jobs. 4 million lost their homes. And the recovery that followed? It was the most unequal recovery in modern history. Stock market bounced back fast. Corporate profits bounced back fast. Wages? Slow, uneven. For many workers, never. By 2010, the top 1% had captured 93% of all income gains from the recovery. Read that again. 93%. The economy recovered. For some people. For others, it just kept getting harder. Fast forward to today. And the math has become almost impossible. The median American household income is around $75,000 a year. That sounds okay on paper, until you look at what that has to cover. Median home price in America today, over $400,000. To afford that home, most financial advisors say your income needs to be $140,000 a year. Almost twice the median. Rental markets aren't much better. In major cities, average rent now eats 40, 50, sometimes 60% of take-home pay. The old rule was that housing should be 30% of income. That rule is now a historical artifact. And don't even get started on college. A 4-year degree at a public university now costs, on average, over $100,000 when you factor in living expenses. The credential that was supposed to unlock the middle class is itself putting people in a financial hole they spend decades climbing out of. Student loan debt in America has now crossed $1.7 trillion with a T. The generation that did everything right, got the degree, followed the rules, is the most financially fragile generation in decades. And here's the part that should make everyone pause. The middle class isn't just a financial bracket. It's an idea. It's the idea that if you work hard and play by the rules, you can build a stable, dignified life. That idea is losing credibility fast. A 2022 Pew Research study found that the share of Americans living in middle-income households had dropped from 61% in 1971 to 50% in 2021. 50%. That's not a dip. That's a structural collapse playing out in slow motion. And the people leaving the middle class aren't all moving up. Behind every statistic is a person. A nurse who works 60 hours a week and still can't save for a house. A small business owner who watched his store survive COVID only to get crushed by rising costs, and a landlord who tripled the rent. A couple who did everything right, degrees, careers, savings, and still can't figure out how their parents owned a home by 30 when they can't afford one at 38. This is not a partisan story. This isn't Republican or Democrat. The trend started before Reagan, continued through Clinton, accelerated under Bush, didn't reverse under Obama, and has only gotten sharper since. This is a structural story, a systems story, and those are the hardest stories to tell because there's no single villain, no one person to point at. Just a long series of choices, policy by policy, decade by decade, trade deal by trade deal. Choices that added up to a world where the game got harder and the rules changed while nobody was watching. So, what do you do with all of this? First, understand that this is real. The feeling that things are harder than they used to be, that's not in your head. The numbers confirm it. Second, understand that every major economic system in history that stopped working for ordinary people eventually broke. The Great Depression, the 2008 crisis, every bubble, every collapse. The warning signs were always there. The people who saw them early made different choices. Third, and this is the uncomfortable one, the middle class doesn't get rebuilt by hoping someone at the top decides to share more. It gets rebuilt the same way it was built the first time. Policy that values labor, investment in public goods, rules that level the playing field. That's not radical, that's history. Your grandfather's middle-class life wasn't luck. It was built, deliberately, brick by brick. And what gets built can get built again. The question is whether enough people understand what happened before it's too late to change it. If this story matters to you, share it with someone who needs to hear it. Like, subscribe, and stick around. Because next time, we're diving into the story of how one small policy decision in 1978 quietly transferred trillions of dollars of retirement security from workers to Wall Street. And most people have no idea it even happened.